Only $250 of this is insured.
Wait, what happens to the rest?
If you've ever moved a 401k rollover into one account, or parked the money from selling a house, or watched an inheritance land in your checking, all in one bank because keeping it together felt safer, hear this before you do anything else with it. David was 64. He'd just retired from 31 years at the same company. He did what a careful man does. He rolled his 401k into an account at the bank he'd used his whole adult life. He sold the lake house and put those proceeds in the same place. Add in what his mother left him, and David was sitting on $340,000, all under one roof, at one bank he trusted completely. He thought concentration was safety. More money, one place he could watch, one statement, one branch that knew his name. Of that $340,000, $90,000 was not insured. Not by the bank, not by the government, not by anyone. If that bank had failed on the wrong Friday afternoon, $90,000 of David's retirement would have become a number on a list, an unsecured claim waiting in line for years to maybe get some of it back. And almost everyone who's heard of this rule has it pinned on the wrong agency. They think it's about taxes. It has nothing to do with the IRS. So what is the number that decides which of your dollars are protected and which ones aren't? And why does it catch retirees harder than anyone else? Let me show you exactly how it works, because once you see it, you can fix it in an afternoon without moving to a single new bank. Before we go further, one quick note, because this is money and it matters. I'm not a lawyer, I'm not a CPA, and this isn't personal financial advice. This is the briefing, the thing that lets you walk into your bank already knowing the right question to ask. If it saves one person in this position an afternoon of worry, hit like so it reaches the next person it can help. Now, about that rule. You may have seen this described as an IRS rule, a tax thing, something new that showed up in the last couple of years. All three of those are wrong, and the reason so many people get it wrong tells you why they never protect themselves in time. The number that decides which of your dollars are safe comes from the FDIC, the Federal Deposit Insurance Corporation. It's a banking regulator. It has nothing to do with your taxes, nothing to do with the IRS, and nothing to do with what you owe in April. The IRS decides what you're taxed on. The FDIC decides what happens to your deposits if your bank goes under. Two completely different agencies, two completely different jobs. And the confusion between them is exactly why people leave their money exposed. They're watching the wrong door. It's also not new. The rule sits inside the Dodd-Frank Act, signed into law in July of 2010. The specific coverage figure has been locked in place since that day. It hasn't moved in over 15 years. So anyone selling you the idea that this is some fresh regulation quietly rolled out to catch retirees is at best confused about the calendar. And it goes back much further than 2010. Deposit insurance was born in 1934 in the wreckage of the Great Depression when the coverage limit was $2,500. Over the decades, it climbed. $5,000, then $10,000, then $20,000, $40,000, $100,000 by 1980. And then, after the 2008 financial crisis, it landed where it sits today. 90 years of history, and most people banking their entire retirement have never once been told the one number that governs all of it. So let's put that number on the table and let's look at exactly what happens to the dollars that fall on the wrong side of it. Here's the number, $250,000. That's the standard FDIC coverage limit. But the full sentence is what matters, so let me give you the whole thing. It's $250,000 per depositor, per insured bank, per ownership category. 4 parts. Hold on to all 4, because every one of them changes the math, and later, 3 of them are going to become your escape hatch. For right now, keep it simple. 1 person, 1 bank, 1 regular account. In that setup, the first $250,000 is fully insured, backed by the federal government. If the bank fails, you get every cent of it, usually within days. Since the FDIC was created in 1934, no depositor has ever lost a single dollar of insured money. Not one, not ever. That's a genuinely remarkable record, and it's why the first $250,000 in that account is about as safe as money gets. The problem is the dollar that lands at $250,001, because above that line in that same single account, the coverage stops. The bank doesn't warn you. Your statement doesn't flag it. The money looks identical on the screen. But that excess is now uninsured. And if the bank goes under, that's where the story changes completely. Let me walk you through what actually happens, because most people picture the wrong thing. They imagine that if the bank collapses, they simply lose the uninsured money outright, gone in a puff of smoke. That's not quite it. What happens is slower, and in some ways, worse. The insured portion comes back to you fast. The uninsured portion becomes what's called an unsecured claim against the failed bank's estate. You get in line. Behind you is a legal process called receivership, where the bank's remaining assets get sold off and divided among everyone it owed. You might get a portion of your money back. You might get most of it back. You might wait 2 years to find out. And the amount you recover depends entirely on what's left after the wreckage is sorted, which is a very different feeling from money that simply appears in your new account 3 days later. Now put David back in the picture. $340,000, one bank, and for the sake of this, one ownership category. The first $250,000, insured, safe, back in his hands within the week. The remaining $90,000, an unsecured claim in line for who knows how long, for who knows how much. Same man, same bank, same afternoon. The only thing that decided the fate of that $90,000 was a line he never knew existed. So if the answer isn't keep less money, and it obviously isn't, you earned it, you should keep it, then what is the answer? Because this is where almost everyone stops paying attention, right at the moment the useful part begins. If this rule is 90 years old, you might reasonably ask why it suddenly matters again now. Here's why. In the spring of 2023, 3 banks failed in the space of a few weeks. Silicon Valley Bank, Signature Bank, First Republic. Together, they held around $550 billion in assets, the largest run of bank failures since 2008. And when it happened, a lot of people who had never once thought about deposit insurance suddenly discovered they had far more than $250,000 sitting uninsured in a single institution. Now here's the part worth being precise about, because this is where a lot of channels get loud, and I'd rather you have the accurate version. In that particular case, the government stepped in and made an extraordinary decision. It covered the uninsured depositors too. People who were over the limit got made whole anyway. So you might be thinking, well, there's my answer. The government will just cover it. Be careful with that. That was a one-time decision, made under specific conditions to stop a wider panic from spreading. It was not a promise. It was not a rule change. There is no law that says the next time a bank fails, anyone above the limit gets rescued. The $250,000 line is the guarantee. Everything above it is and remains a judgment call made in the moment by people you'll never meet. And you do not want $90,000 of your retirement riding on a judgment call. That's the whole reason this is worth an afternoon of your attention, not because your bank is about to collapse. The odds of that on any given day are genuinely small, and I'm not here to scare you into moving your money under a mattress. It's because the cost of fixing this is basically zero, and the cost of ignoring it, in the rare case it matters, is everything above the line. When the downside is that lopsided, you close the gap. Quietly, correctly, and without paying $1 to do it. Which brings us to the part David's story was missing. The 3 moves that would have covered every cent of that $340,000 at the exact same bank without him opening a single new account somewhere else. Remember the full sentence from earlier. $250,000 per depositor, per bank, per ownership category. We've been treating that as one flat limit. It isn't. That last piece, per ownership category, is the door most people walk right past, and it's the one that would have saved David without him lifting much more than a pen. An ownership category is just the legal capacity in which you hold an account. And the FDIC gives each category its own separate $250,000 limit at the same bank. Stack the categories, and you stack the coverage. Let me show you what that actually looks like, because this is where the $90,000 problem quietly disappears. Start with a single account, just you. That's category 1, $250,000, insured. Now add a joint account. Say David holds an account with his wife. A joint account insures each co-owner up to $250,000. So 2 owners means that account is covered up to $500,000. On its own, that one move more than covers David's entire balance. But let's keep going, because it's worth seeing how much room the system actually gives you. Add a retirement account. Certain retirement accounts held at the bank, a traditional or Roth IRA and a bank deposit, get their own separate $250,000 of coverage on top of the personal accounts. That's category 3, a fresh $250,000, same bank. And then there's the one that surprises people most, a payable on death account, sometimes called a POD or a revocable trust account. Here, the coverage is calculated per named beneficiary. Name 1 beneficiary, that's $250,000. Name 2, that's $500,000. Each person you name as receiving the money when you pass adds another $250,000 of coverage to that account. Sit with the arithmetic for a second, because it's genuinely large. A married couple at one single bank, using their individual accounts, their joint account, their IRAs, and a POD account with a couple of beneficiaries, can end up with well over $1 million of fully insured coverage without ever setting foot in a second bank. David's $90,000 of exposure wasn't a problem that required moving his money across town. It required moving it across categories, on paper, in an afternoon, at the branch that already knew his name. That POD piece, by the way, does double duty. And if you've been with me for the video on what happens to a bank account the day someone dies, you already know a payable on death designation is also what keeps the account from freezing and going through probate. Same tool, 2 different problems solved. If that's news to you, that video's worth your time after this one. So that's the first move, categories at one bank. There are 2 more, and they're shorter, but they matter for larger balances. Before I get to them, I'm curious where you land on this. Drop a comment and tell me. Had you ever heard the phrase ownership category before today? Or is this the first time anyone's laid it out? I read those, and it tells me what to cover next. The second move is the obvious one, and now you understand exactly why it works. Spread your money across more than one FDIC-insured bank. Each separate bank gives you a fresh $250,000 per category, because the limit is per depositor, per bank. $250,000 at your first bank, another $250,000 at a second, and so on. For most retirees, combining a second bank with the ownership categories we just covered is more than enough to cover any balance they're realistically holding in cash. The third move is for larger balances, and it's the one fewer people know exists. There are services, offered through some banks and some financial firms, that take one large deposit from you and quietly spread it across a whole network of partner banks behind the scenes. You write one check, you deal with one statement, but your money is sitting in insured slices across a dozen or more institutions, each slice under the limit. The result is a single relationship with FDIC coverage running into the millions. I'm not going to name providers, because the moment I do, this turns into an advertisement, and that's not what this is. I'm telling you the category exists so you can ask about it by name, a deposit network or a sweep service, if your balance is large enough to need it. Now, before you go rearranging anything, here's the one step I'd want my own parents to take first. The FDIC has a free tool on its website called EDIE, the Electronic Deposit Insurance Estimator. You type in your accounts exactly as you hold them, and it tells you precisely how much of your money is insured and how much is exposed down to the dollar. It's free, it takes a few minutes, and it's the government's own calculator, not a salesman's. Before you move a single dollar, that's where you start. Find out where the line actually falls for your specific setup, then decide which of these 3 moves you need. Some of you will need all 3, most of you will need 1. And if this is the first time anyone's shown you that your bank accounts have a ceiling you can actually control, do someone a favor. Share this with the person in your life who just sold a house, or just rolled over a retirement account, or just inherited something. That's the person sitting on a lump sum right now with no idea there's a line. This is the video that gets to them before the wrong Friday does. So let's bring this back to where we started. This was never really a warning about your bank failing. The odds of that are small, and I'm not in the business of frightening people about things that probably won't happen. This is about something quieter and far more within your control, knowing which of your own dollars are actually protected and which ones are just sitting on the wrong side of a line nobody ever showed you. David didn't lose his $90,000. His bank didn't fail. But he spent a year of his retirement not knowing he was exposed, and the only thing standing between him and a very bad outcome was luck. You don't have to run on luck. You can go check ED this week, see where your line falls, and move a few things across categories or across a second bank until every dollar you worked for sits on the safe side. No cost, no salesman, no permission required. One last time, so we're square. I'm not your lawyer or your financial advisor, and this is education, not a personalized plan. Your exact situation deserves a real conversation with a professional who can see all of it. But now you walk into that conversation already knowing the number, the categories, and the right questions, which is a very different position than the one David was in. If this was useful, subscribe, because everything on this channel is built to do exactly what this did. Take a rule the system runs automatically and hand you the part of it that protects what you've already earned. It's already yours. Let's make sure it stays that way.